Hello, everybody. Jackson here with the Wealth Squad. Today we'll be talking about the stock market and asking ourselves a very informational question and a very emotional question, right? We're asking ourselves, is this the bottom? Have we reached the bottom? Or, a couple percentage points close. Well, let's talk about Carvana today. Carvana is one of those tech companies that came and went, essentially. They are pretty popular during pre-COVID, right? And post-COVID, the stock shot up from 100, pre-COVID, to $30 at the very low, to a high of 360, now down to $8. If you haven't heard, that is because of their earnings report. We could actually see that here. So 2 quarters ago, we're looking at losing 289 a share. This quarter, 235 a share. Or last quarter, in this quarter, 267 a share. Essentially, they're losing $2 billion a year in, as a net loss. But we learn more about Carvana, and we could actually see their market cap is 1.6 billion. And their bonds, which I don't have access here on TradingView, but they have bonds paying 20% guaranteed. Guaranteed only by the company itself. If the company goes bankrupt, you're not getting paid. So that is what is at stake here. For Carvana is essentially going bankrupt. Hopefully no one has held from any price. After you buy at 200, let's say, and it goes down to 130 or 100, you got to at least ask yourself if you should cut losses. And most of the time the answer is yes. If a stock gets split in half in a short time period while you're owning it, chances are it will go lower. For the time being, right, you could always buy back if you really want to. In Carvana's case, you probably should not do that. So now that is why I asked myself if this tech bubble type stock, right, the ones that come out from excess, implode, as essentially that's what Carvana has done. It's imploded. Shouldn't we ask ourselves, is there much more left? So that is what I'm going to look at today. This is actually the log chart. You can see the IPO was in 2017 for $12, hit a low of $8.22. Now looking at the price today of $8.76. That's the close. So a very bad day for Carvana. We could actually see the chart today. $14 down to 13 after a bad earnings report and fell all the way down to 8. So looking at some other mega cap stocks, we're going to ask ourselves, is this a good time to start buying more? Is this a good time to at least ask ourselves, is this the bottom? First stock that comes to mind is, of course, Apple. But Apple hasn't been hit too hard considering everything else, right? We're seeing highs of 180. Right now we're trading at 138, so down $50 from the high, which is essentially 24%. So down about a quarter, right? Looking at the 5-year chart, they're still doing relatively good. And this is after that stock split. So we can zoom out. You see they had a stock split 1 for 4, I believe, or 4 for 1. So every single share at this price was trading for almost $400, sorry, $380. And then they split it, 1 share equals 4. So now this share price, $130, is essentially $520, I believe. Yes, $520 pre-split. And this was 200, right? So you have to ask yourself, dang, Apple went all the way down to 120 during the COVID crash. Now it's at 520. Is that really such a good deal? I don't know. Sure, that business has exploded since then. I do think there's better deals out there, right? 72 cents, $1, 61 cents. Now we're looking at earnings of $1.29, $1.20, $1.52, 210. So they've stayed consistent, they've stayed constant over $1. But is that really the best deal out there? I don't think so. So let's keep looking. Microsoft also comes to mind. One of those stocks that has been hit pretty hard. A high of $350 and a share price of today $2.20, so down 37% compared to Apple's 25%. Last time Microsoft has been this low is January 2021, so it's been a whole year, and Microsoft has not really, a year, almost 2 years, I should say, almost 2 years, and Microsoft has not really moved in share price. Sure, they pay a dividend, although relatively small, $2 a year. Hasn't really moved. So Microsoft, not a bad deal considering. Let's actually look at those earnings. We're looking at $1.82, $2.03, $1.46. Now we're looking at $2.23, $2.35, $2.22. So back when Microsoft had the same share price, we were getting $2 a quarter, or $2 per share in income. $1.82, $1.46. Now we're getting $2.35, $2.23, $2.22, and next quarter we're expecting $2.30. So earnings have gone up, but the share price is the same. That's how you know that you have a good deal. Of course, if the earnings are falling alongside the share price, then it makes sense. You don't want to buy that. But the earnings are growing, albeit slow, but they're growing compared to the share price, which is falling. You know you got yourself a deal. Next, let's look at Google, which is number 3 on that largest company, right? Largest company is Apple, Microsoft, Google, I believe. We're going to also miss like Tesla, Berkshire, and then there's Amazon in there as well, which we could look at. So let's look at Google. Last year's earnings, right? Or last time it was this low, December 2020. So 2 years ago, right? 2 years ago, we're looking at 82 cents, $1.11, 50 cents. Oh, that's during COVID. So 82 cents, $1.11, and all the way up here, $1.30. Last quarter was $1.20. This quarter was $1.06, which they missed a very bad earnings report for Google, down 16% from expectations. Next quarter, $1.20. So earnings right now are $1.06. Last time it was this price, earnings were between $1.11 and 82 cents. So that makes sense, right? Earnings haven't really grown too much. They are expected to grow, however. So Google is also trading at a deal compared to what it was 2 years ago. It's also down 43% more than Apple and Microsoft. So next, let's look at Amazon. All these stocks so far, they're all looking like pretty good deals, right? Microsoft probably the better move because earnings have grown pretty well. I think it was 15% when the share price has stayed the same, and Google was kind of right where it was. So Amazon, different story between Microsoft, Google, and Amazon. Amazon has done much worse than the rest of the stocks. You can see it's trading at under $90. I'm sorry, $98. Pre-COVID, I'm saying way pre-COVID, 2018, the stock price was 102. Well, this is pre-split, so it'd really be 2,000 because the split is 20 for 1. So we're talking $2,000 share price. It hit a low of 66, and that's essentially times 2 times 10. You're looking at 1,200, 1,300. And now pre-COVID it hit 108, then it hit a low of 85, and that's 1,900. That's $1,700. Now it's trading at 90, which is $1,800. We're trading at $1,800 compared to 4 years ago for 2,000. And now we have to ask ourselves, what about the earnings in that time period? So we're looking 25 cents, 28 cents, 30 cents, okay. Pre-COVID, we're looking at 32, 21, 26. Now we're looking at 28. Last quarter, they lost money. You can see that here. The quarter before that, they lost money. And the quarter before that, they made $1.38, which is, I believe, the most they've ever made. Yeah. So Amazon's all over the place. We could actually find this by looking at macro trends and get an exact actual data set, right? We're looking for Amazon EPS. Now, Amazon's one of those weird companies. They don't really care about profit as long as their sales and business is growing, at least at this time in Amazon's company history, right? We're looking at quarterly EPS. You can see up and down, up and down, up and down, up until 2017. Then it's consistently making money, right? 16 cents a share, 30 cents a share, 35 cents a share per quarter. Up here is yearly. 62, 71, 79, 76, 31, and then the last quarter, or at least December of last year, $1.38 a share, where their annual EPS was $3.23. Pretty good. Now, last 2 quarters ago, or I'd say 3, was they lost money, 38 cents a share. Then 2 quarters ago, lost 20 cents a share, and now this quarter they made 28 cents a share. So their earnings annual EPS is still $1 a share, which puts this stock price at, or I'm sorry, the EPS of what was it, $1 a share, and the stock price is $90. So you're looking at a 90 PE ratio. Of course, that's not really the truth when the company is growing and the sales and stuff are growing, but they just don't really care about the profit now. So that's a different story. Sure, the earnings all over the place. The company is bigger and better than ever, but with, of course, a drawback in demand for sometimes, you buy stuff on Amazon that you don't really need. There's definitely a drop in demand for that because people just don't have the money anymore, at least at this moment. So it makes sense why the stock is falling. Maybe not the best deal out of the 3, but it is the most innovative, I'd say, and down half of what it was just a year ago. It's down half, $188 to $90 right now. So, in my opinion, a lot of these stocks are undervalued. I'd say Google, Microsoft, definitely. We could also check out Meta. One of the ones that's like, if you could see this go all the way back to all-time highs, it'd be a miracle, essentially, at this time. But you can see that earnings, $3.60 a quarter, $3.20, $3.60, now $1.60. Next quarter, $2.30. So not terrible, but their stock is literally down 70%. It's a 50% cut in earnings, but their stock is down 70%. So you have to ask yourself, is that little margin good enough for me to buy the stock? And that's up to you. That's a personal opinion, right? Sometimes it's best to avoid the ones that are hurt the most, just so you don't get all that drama. Everyone's going to be watching this stock. It goes up, people are going to be selling because they're breaking even, something like that. That's bound to happen along the ways. It's a rough future for Meta, for Facebook. However, there is a future. It's not going bankrupt anytime soon. They got a lot of cash, very little debt. Meanwhile, they're putting all their money into VR, AR, and they have a very profitable, consistent income from Facebook, Instagram, WhatsApp, those apps alike. So whatever you think, hopefully you're thinking that the future ahead of us is much brighter than the past. I at least hope so. That's the case. I'd say Google and Microsoft are pretty good deals right now. Amazon, Meta are questionable, although there are deals out there besides these companies, right? These are the largest companies ever. You could go look at companies, $5 billion, $10 billion. You're bound to find some gems. Hopefully you do that. In the meantime, stay safe, make some money so you can invest some more. And that's all for this video. I'll see you guys next week. Thanks.